Welcome, welcome to Is Now a Good Time to Invest in Property? We're going to be looking at property primarily as an investment, you know, buy to let, holiday lets, student lets, that sort of thing, more than buying it as a property to live in. But we will touch on buying to live in as well. And to answer my questions and your questions, and do feel free to ask questions, put your camera on. It's lovely to see your faces. And so you can just put up your hand or put that little hand thing, you know, reactions, click on reactions, put your hand up. Or you can ask questions in chat if you don't want to speak. So ask as many questions as you like, because I've got the experts here. This is your chance. Firstly, I've got Daniel Jackson. Daniel, give us a wave, from Secure Investment. Thank you, Daniel. Daniel is Sales Director at Secure Investment, and he has over 20 years experience in the property sector, specialising in the North. And Secure is a nationwide build-to-let specialist in the UK, having sold over 3,000 buy-to-let properties to the tune of £300 million. We also have Mark von Groundhair. Is that how you say it? Groundhair or? Groundhair, good name. And he's director of Benham Reeves, which is one of London's longest established lettings and sales agents. And Mark oversees the company's rental operations as well as developing new business. And we also have James Forrester, who's managing director of Barrows and Forrester, and also Stripe Homes. So that's a Birmingham-based estate and lettings agent. Yep, that's where you are, I'm guessing. And the Newcastle. Oh, that's Barrows and Forrester.
Yeah, I was in the back. You're right.
It's the other way around. Okay,
yeah,
so
not bad. I'm in the webinar at the minute. Can I give you a call back? Okay, see you a bit back.
And also Barrows and Forrester. So we've got, I'll say that again. So Newcastle-based property developer Stripe Homes and Birmingham-based estate and letting agent Barrows and Forrester. And Correct. You're in the Birmingham office at the moment, aren't you, James?
Oh, well, I'm in my house, but I am based in Birmingham at the moment, yes.
Great. Oh, that's really good. Oh, we've got people joining. I'll just let them in. That's excellent. Good to see everybody. Jackie, good to see you. Shanice. Oh, James, you're here. James Lockett's here. Just making sure everything's going well. That's nice. James, just to let you know that we are recording this, and to let everybody know, we're recording this, and I will be uploading it onto Money Magpie later on with an article attached to it. So I'm going to start by asking the main question, and I'll start with James. James, overall in the UK, would you say is now a good time to be actually investing in the property market, or should we all wait a bit? What do you think?
I'm always a big believer to assess the masses and do the opposite. And I would say at the moment, a lot of people are worried about what's going to happen in the future. So the best time is to buy now. I think we're in a perfect situation. You know, we typically always borrow money to purchase. It's the cheapest time to borrow money. You know, and that's when you want to be getting your hands on it as well. Now, yes, people could say prices might be slightly inflated because of the stamp holiday duty, etc. But if you're savvy and you're building up good relationships with estate agents as well, you will find good deals out there. And you've got to look at the strategy of what you're looking to invest in, you know, and how long term it is. I'm a big believer you should be keeping property for 10 to 15 years, you know, and if you're doing that, you will reap the rewards on it. So, you know, I think, you know, especially up in the north, you know, you can get great deals, but there's also certain places in the north that have never changed price. So you've got to be aware of exactly where you're investing, what you're investing for, and do your research. But look, you know, as estate agents, we're not bad people. You know, we're not, I know we're one of the less trusted people in the professions of everybody, but we're probably more trusted than our current Prime Minister. So, you know, we will give some good advice.
Oh, I don't know.
I'm a journalist. We're well down in the bottom. Amoeba, bog brush journalists. Is that sort of where we are? Mark, what do you think? So you've got a field around London, primarily. I say field. Your field of expertise, particularly, is London, but you know elsewhere as well. What do you feel about the investment opportunities in property right now?
So I think it's interesting. So yeah, we are mainly a London business. We have 18 offices in London, so we're covered throughout, you know, the capital. We also have offices in Asia, so Hong Kong, Singapore, KL. The reason I mention that is because obviously we deal with a lot of investors. I mean, my view is it a good time to invest at the moment? it's not a terrible time to invest, but you are competing with everybody trying to get across the line on the stamp duty holiday. Now, I think that, yes, there are deals to be had, and certainly I think London is a challenging market. You know, lack of travel, the travel restrictions, there isn't this, you know, there's hardly any people from the Gulf here. There's no one here from Russia. There's no one here from Asia. In fact, there's no one here from anywhere, even though the virus is here in abundance. But I think the fact that the lack of people being here, and especially the lack of people from the Gulf who would traditionally be here after Ramadan buying like mad, that means there's been a definite slowdown in the London market. Yes, there are transactions up, but prices are still really flat. So I struggle to say that now is the best time to buy right now. I would tend to be waiting until July is out the way and the stamp duty holiday is gone. So there's no more chasing to try and chase your tail, pay your law an extra £1,000 to get it across the line and try to bribe everybody. There's none of that gone. And I think if you can wait until July, I think the market will be quieter and more August than July. I think the market will be slightly quieter. And then I think you're going to see more keen buyers, because I think buyers are still holding their values. And yes, there has been some reductions in prices in London. Outside London, the market is very buoyant, and we've seen this in the stats with prices going up. But London itself is incredibly challenging, whether that's, you know, the prime market, the super prime market, or the suburb. You know, the suburbs have done well, but I think it is, you know, I think property should be a part of anybody's investment portfolio, but I would personally wait until the end of the summer before I start looking at it. And there will be deals.
Well, that's what I'm thinking. But and you're thinking particularly London, because I mean, like James says, go against the crowd. And of course, people are coming out of London. So it seems to me that if you want a deal, central London is a pretty good place to be looking.
I think the value so as I said, a lot of our investors are from Asia. So we have about 1,000 clients in Asia. In fact, I think it's 1,500 now. But anyway, we have a large number of clients in Asia who buy for investment. Because of the lack of travel and the amount of, you know, the reduction in numbers, I actually feel that now is the time to get deals in central London, because the buyers aren't there. And as James said, interest rates are as low as they possibly can be. You can borrow really easily. Yeah. And I think now is a good time. But as I said, I would wait to get the stamp duty holiday out of the way, because then as the summer market comes, it always goes slightly quieter. I think that's a really good time.
And Daniel, you specialise in the north. I mean, that seems really buoyant to me. But would you say still that now is actually still a good time, or should you wait until the winter?
It's always a good time to invest. I think I've always been an advocate of buying a property and then waiting, rather than waiting and then buying a property. You know, that's something that's sort of been drilled into me over the 20 years I've been in the industry. And anyone that waited 20 years ago and didn't take the plunge would look a little bit silly now, having missed out on a fantastic capital uplift and all of that nice rent and return on their investment. So the two most important prices are the price you pay and the price you sell for. So I think as long as you're in buy-to-let for the long term, whether that be 5, 10, 15, 20 years, I think it's always a good time to buy, providing you can get a deal. You know, it's a case of trying to find that right property that's going to give you the right kind of return at the right price. So regardless of what the market's doing, you know, in the wider sense.
So you're saying the same as James, essentially, that if you're going to buy property, stay there for keep it for at least 10 years. It's a long term. Correct.
Yeah, buy-to-let has got to be a long-term process. I've seen too many people try and take a short-term view, and they can then make mistakes. So providing you're in it for the long term, I think, you know, property is always a sensible asset class to have within a wider portfolio.
And yeah, as I was saying just at the start, we get these sort of national figures, but the regional reality is so different from the overall, the average. You know, you almost pretty much might as well ignore them. So would you say, again, I'll go back to you, James, would you say that things are most active in the north at the moment, or are there some surprising pockets elsewhere that are looking really interesting?
Yeah, I'm a big believer of always just, speak about what you know. So London, I can't talk about that. I'll leave that to the expert who's on the call, Mark. From that, obviously we have various branches around the Birmingham, the West Midlands, which is obviously a massive hotspot for property at the moment. What we're seeing is, I think a lot of people do compare, your Manchesters, Birminghams, your Leeds, your Newcastles to be mini Londons, and they're not. London is a separate category on its own when it comes to property values and the way the market, does turn. We don't get the massive influx of the Asian, the Russian buyers, for example, as London will. We get a percentage of them, but not in the same sort of demand. So what we've seen, if I take Birmingham as a great example, it's gone through, I was having this conversation yesterday with someone, 7-8 years ago, there was no high rise, virtually in Birmingham. There's very little being authorized. Now they're authorizing it for the sake of it, which is probably not great. And the infrastructure is not improved with it. We put our clean air zone into Birmingham as of the 14th, so you now get charged if you don't have a new car, basically. There's one electric car charger that works in the whole of Birmingham, and they want you to go to electric. There's hardly any cycle lanes, so for people on bikes and electric scooters, it's not there. The buses are being diverted because of all the road work. So you start to see the changes that aren't happening. What we are seeing is in Birmingham is the outskirts really starting to boom. Walsall, for example, if you look at it, you shouldn't go there, shouldn't walk around there at night time. That's what people will tell you locally. It's probably the big hotspot in the West Midlands, going up. A lot of money is being pumped into the infrastructure. You're right off the M6, so it's easy to get anywhere. You've got the local trains running through it. The metro will eventually come to Walsall. It's already been announced. So you can see the big demands that are going to happen from there. So I think if you can look on the commuter belts, I think you'll do very well on that point. But you do have to know your area. I think that's the key thing. I've seen it too much. People go, it's Birmingham investment, but it might not be Birmingham. It might be 20 minutes away from Birmingham. Even that local area is so different for what you can achieve. And again, it does come down to what you're asking for and what your strategy is. And it's something I try to do with all my investors. And I have my fair share of overseas as well as UK based. And, I always try to find out what their strategy is first, so I can try and advise them as good as I possibly can to tick every box as much as they need. And, the market will take care of the rest of it.
And Mark, again, we have already touched on how London is essentially suffering at the moment and has been. But do you see what do you see for the? I want you to get your crystal ball out here. What do you see for the next sort of year or two? Because we're looking potentially at rising inflation. Who knows how much job losses, etc. So what do you think with London? As things open up, do you think people will come back, or do you think it's going to actually go down a bit even further?
So I honestly don't think there's going to be any more drop in London market. I think I'd love to be the person with the crystal ball that can always, forecast the bottom of the ramp so I can buy. But, it's always very difficult to do that. But I think we have been as low as it can be for a while. London has been under pressure and been a very challenging market for the last 3 years now. And I think as things return and when travel restrictions open and those buyers come back to the market, that will be, number one, a big help. Number two, there's been obviously this massive drive to working from home. Because obviously COVID encouraged everybody working from home. They don't need to come into the city. People thought, you know what, if I don't need to come in anymore, then I'll sit at home and I can buy a larger property, maybe a bit cheaper in the country, a nice garden. Now, I actually think that you're going to see, as businesses, Goldman Sachs is a prime example that came out. What did the CEO say? That working from home is an aberration and no one should ever be allowed to work from home. It's like a day off. You've got other large companies coming out and saying the same. I mean, and I think that you're going to find that a lot of people, as they start being drawn to come back into the office, I mean, not us, because obviously we've worked throughout the whole thing, but as major employers come back in, then people that are now sitting in the home counties or maybe 2 hours from London on a train, they're going to be sitting on that train in the morning. Number one, they're going to find out that travel is costing them £10,000 a year as opposed to that it was on Zone 1, even though that's expensive. Number two, they're going to be sitting on a train, on a packed train going in and coming out in the morning and the evening. They're not going to be in London to go out for drinks after work. They're not going to have all of the social life that London brings. And I'm using London because that's where we primarily are. But I think it'll be the same for the other cities, major cities. And I think you're going to see people reverse that trend. I'm not saying that everybody's going to rush back, but given the fact that prices are, at a decent, reasonable level at the moment, and people can get deals as people start to come back, I think you're going to see people come back in. And I think those two factors, travel returning, and people being able to, wanting to be back in the cities, I think you're going to see prices start to move. And people will be surprised. I don't even think, with the stamp duty costs of moving, it'll be expensive, and I bet you that will lead to a massive call, which he won't do, for the Chancellor to do something again on stamp duty to help people come back into London.
Yeah, he won't.
He's going to do.
I really don't think he will. I mean, they need to claw money back, not give it.
I know. But I definitely, I think now, I'm saying wait till after the summer, but I genuinely feel, prices are going to start to move back up. And people will return. The other thing, the factor that no one's mentioned that everybody's talking about is BNO visa holders coming in from Hong Kong. There are millions of them. We let to 15 BNO passport hold visa holders yesterday in one office. 15 lets we did yesterday to 15 individual people coming from Hong Kong with the visa holders. We're up to over 100 so far this year. That's a big market. These people are buyers. These people are investors as well as buyers. They're not the mega wealthy. They're, circa £300,000 to £500,000. But that's again another set of buyers in the market.
So it's gonna grow in London. Yeah, it does feel like that. I must admit. Now, if anybody wants to ask questions at any point, just open up your open up your volume, open up your microphone and say, hi, I have a question. This is absolutely open to everybody. So I'm going to continue to ask questions, but I'm very interested to hear what you guys want to know from you've got the experts here, you've got them for a whole hour. So do ask any questions anytime you like. Actually, one question I was going to ask you earlier, Daniel, and I forgot. Could you explain to everybody what does it mean, build to let? What does that mean?
Well, it's buy to let, not build to let. So we Secure are a specialist buy to let agent. So in effect, we are an estate agency, but we specialise in the buy to let market. So we don't deal with Mr. and Mrs. Smith on the high street who are looking to sell their property and move up or down the ladder. The properties that we deal with are specifically for buy to let investors.
I see. Well, James, you're here. It said build to let on the information you gave me. So, but that's interesting though. So that you specifically deal with buy to let. So if anybody's interested in buy to let, particularly in the north, then they come to you, and you must be really, really busy at the moment then.
Extremely busy, yeah. We did a deal with a client yesterday that was looking in London and isn't buying there for the reasons Mark mentioned earlier. Bit of a stagnating market, and was able to buy 4 properties for the same kind of capital that they would have used in London for one. And we've managed to secure them. I think it's about £1,300 to £1,400 a month more on the rental income as well, by buying cheaper property with a high yield. So it depends on individual strategies, what they're looking for, whether it's yield driven, growth driven, a little bit of both as to where those clients will invest. But yeah, we deal with the whole of the country, not just the north, although we're based in Manchester, but we have tended to stay away from London, typically just because of high prices and low yields. But yeah, we've had deals in far south as Ipswich, Portsmouth, as far north as Newcastle, so right across the board. So
Daniel, if we could just talk about yields again. So it's particularly, I don't know about the people here. I don't know how much experience you've had in investing in property, but one thing that I keep thinking about when it comes to buy to let, etc., is that you really, really, really have to look at it as a business. It is, you just have to be really hard nosed about it. Look at the numbers. look at, as you say, do you want growth? In other words, you want to buy something that's going to increase in price, or are you going for yield? In other words, you know, a really good return on the rents. How do you, let's have a look at yield, Daniel. How do you work out if something's going to be a good yield, if it's going to give you a good return on your investment?
Typically, a good yield looks anything between 7 to 10%. So if you can get those kind of numbers in terms of the rental income divided by your total purchase price, that would be a good yield. I mean, you can go, you know, James will probably echo what I'm about to say. You can go up to parts of the northeast, parts of Yorkshire, and you can even start, and even Lancashire as well, and you can start to look at 10 to 15%. But those kind of yields will be properties where values haven't moved for years. So again, there'll be certain types of investors that will quite happily buy those kind of properties because that's all that they're targeting is yield. But there'll be no growth there. But if you can get 7 to 10%, I think you're doing pretty well.
Very well. And when you say yields, sorry, on your investment, so give us some figures. Say, for example, you bought a property that's 100 grand and maybe you've put in 20 grand. What would you expect as a return? What sort of rent?
A return on investment. So if you're buying with a buy-to-let mortgage, you're typically just using the figures you've used there. So 20k in on 100k, so 20% deposit. After you've paid your mortgage and any running costs, you know, if it's an apartment, you'll have a ground rent and a service charge, and maybe pay a letting agent a management fee as well. And you would typically look to try and get a return of between 10 and 15% on your 20 grand each year. That's net. So those are the kind of figures that you would look to achieve on an ROI basis. And that's purely based on the return versus the money that you've physically put into the property as a deposit.
Mark, I'm guessing you can't really get that in London. It seems to me, you know, I mean, I've spoken to estate agents or lettings agents who said, oh, yes, we can get a yield of 3% on this. And you go, 3? Really?
I know, and you're 100% right. I mean, I think, you know, the yields that Daniel's talking about, and certainly James, if you can get 15% yield, that's amazing. But I'm pleased you said that. I'm pleased Daniel said that those yields are generally on properties that have done no capital growth. Yeah. So, noting that the last few years have been challenging, the reality is with buying a property in London is you are looking, or really in the UK generally, is you're looking for capital growth as well as yield. You know, yield is great if you're happy to pay income tax on it and you need the income, but actually, you know, I would always want to have capital growth. And I'm not saying that I'm suggesting that, you know, 3% is quite good for certain parts. I've got some stock at the moment, some clients have where they get a sub 2%, and that's a gross yield. Before you pay the service charge, you know, where they've got, you know, I've got a block at the moment where it's £25 a foot for a service charge. On a 1-bedroom flat, it's costing them £12,500 a year on a service charge. You know, these are not income plays. These are, you know, buying an asset that you're going to hold that's going to increase in value. And I say to investors, you know, and I think Daniel said earlier, this is not a time to buy something and be thinking I'm going to flip it, because flipping is impossible. You can't sell within 2 to 3 years anymore to make a profit with the stamp duty and the soft costs. It makes it impossible now. You have to be looking at a 7 to 10 year hold. And, you know, I think general yields in London on the outskirts, zone 4, zone 5, you can get almost a 5% yield. We've got a scheme at the moment, actually, we're working on at the moment near Heathrow, and we're letting there. And our yields are just under 5%, which is near Heathrow Airport. It's not bad, but it's not 10%. But the aim is always to get capital gains with it. But, you know, at the moment, it has been subdued.
Yes, and it's a risk. I suppose with income, you know, you're getting whatever, at least for the moment.
Well, no, but if you're reliant on the income, the thing to bear in mind, and this is the big thing that a lot of people don't take into account with investments, is with property, is, you know, it's only as good as your tenant is. Your tenant is the driving factor. Now, a lot of the high yields, and maybe James and Daniel will correct me, are driven by council benefit paying tenants. That's an enormous market. Now, that's okay. and that's a different type of market. But I'm talking about private tenants. In London, you know, we let 3,500 properties a year. Those are all to private individual tenants, and obviously companies as well. Now, you're going to have some that struggle to pay, and that's going to kill your yield. And that doesn't matter whether you're getting a 3% yield or a 15% yield. It's more painful if you're getting a 15% yield and you're getting nothing because they're not paying, or you have to do some, or you have to pay some, but you can protect yourself and cover it. But, you know, it isn't this bed of roses. You have to have your eyes open. I always say to investors, invest what you can afford and be aware of the risks, because there are risks with it.
Well, that's the thing, isn't it? There are a lot of risks. So James, you're nodding your head a lot here, because I mean, it is an interesting point. And I know people who only rent to DSS essentially. And do you think that is a good way to get yield, James?
Well, now you can't refuse any tenants coming in. It obviously comes down to landlords' decision on what they want to take. 9 out of 10 of them typically don't want DSS. You know, and we're driven by what the landlord wants to accept after all the checks are done. And I think, like what Mark's just said, what Daniel's touched, you know, this is where I'm really controversial. I hate the areas that give the 15% stuff, you know, especially in the Northeast. I know them off the back of my hands. They've not changed in, you know, 30 years, 35 years of it. I don't think they will change. Unfortunately, there is a demographic of tenants. We're always tarnished if we talk about it, but they probably won't pay their rent as well. And then, you know, things will change. And if you're not getting any, you're renting, well, you're not getting any yield in the first place. You're actually earning nothing as an investment. And that's where your risk comes in, even down into the private sector. You know, if I'm looking at Birmingham, you know, you will hear 8 and 10%, but realistically, you're at your 6s to 7.5s, you know, and it all depends. Again, I'm massive on this. It all depends on your strategy. Are you buying in, you know, your sort of, you build into rent, or you buy to rent, whichever you want to call it. But, you know, you've got a lot of landlords who are buying, you know, second-hand homes. They're refurbing them. They're going to rent them. And it does come down to the type of tenant you want. And, you know, we will go to a lot of properties and you can see dishwashers not being changed 10, 15 years, washing machines. You know, they expect the tenants not to complain if anything goes wrong. And when you've got a lot of new development, especially in the north, because, you know, your major cities of Manchester, Birmingham, things like this have seen, you know, the big influx of new developments now. Newcastle, which is where we're building, one of my other companies, has hardly seen any new development in the last 12 to 14 years. So it's quite unusual for, you know, to get a compromise of where we are at a price per square foot. It's very impossible because there's been no new buildings, you know, to sort of to compare to. But landlords have got to be prepared if they're going down the yield and they want the rent and they want the steadiness. And like Mark said, it's all about the tenant. This is what it does come down to. If you want to get your rent, it's as good as the tenant that goes in, then you have to spend money. Unfortunately, you don't want to hear that, you know, but it's a business and you've got to put the money into it. You need to give it the paint. You need to put the new utilities in, because as these new developments come along, they look good, they're shiny, they're amazing. People want them, they want the services, the amenities. You are competing with them. No matter how you look at it, you are competing with them. But if you can do your upkeep on it, and I think this is the good thing about the American TV programs we watch. Yes, it's not all roses as it gets shown, but the key thing is they look at it as an asset and they will spend money on it to make sure they've got happy people going forward. Because most places around the UK, you only need 1 or 2 months rent lost and your yield's gone, you know, for the whole year. So you're better off just spending that little bit extra, a bit of care and attention. Your tenant will pay. Your tenant will typically stay for a lot longer as well. And if you've got a tenant in for 3 years, at least you know where you're going on it and you can start to plan for your next investments as well.
That's really interesting. And Daniel, I'm just thinking, you know, as we're talking about essentially risk and reward. So as we know, you know, the higher the risk, the greater the reward is on the whole. The lower the risk, the lower the reward. So when we're talking 10, 15% yields, would you say those really are the risky ones, that you'd need to have a few to make sure that, you know, you cover yourself?
I mean, the guys are, you know, I think it will be unfair to say that every property out there that generates those kind of yields is problematic and you'll get problem tenants. It's not the case. Yes, there's always going to be a few people out there that won't pay the rent. And that can be said of you know, your more expensive rents on properties in London and central Manchester, you know, Oxford, Cambridge, your more expensive areas. But yes, definitely, if you're dealing with DSS tenants, and there will be a few that will maybe not treat the property as nicely as someone else would, maybe just miss the odd month of rent here and there. So I think that's a fair comment. So for a lot of landlords, yes, you've got to go in with your eyes open, certainly. And for some people, that won't be the right investment strategy. For others, they're quite comfortable with that and will move forward. So for the ones that aren't and don't want to take as many risks, putting a little bit more money in and buying something that's more expensive and slightly lower return will mitigate those risks and potentially give them a property that, yes, has got a lower yield, but will be in a better area where there's more potential for capital growth going forward. So it's finding out, James alluded to it before, and Mark did, finding out what your client's strategy is and advising that client, especially going forward, what we think will suit your situation.
I'm going to throw it open to the crowd here. Jackie, Harvey, Steve, Annie, Phil, Rosemary, Monica, Andy, Shanice, James. Oh, James definitely happens. B or Tom. Now, have any of you invested in property, or are you thinking of investing in property? And Annie, what's happening with you?
Yeah, in Nottingham, I'm invested. Yeah, but I actually wanted to ask about the holiday market. What's the opinion about that?
Very good point. Yes, I'm interested in that as well. James, tell us, what do you think?
UK or overseas?
Both, actually.
So I sold overseas for 12 years, so I know that market really well. I think the UK at the moment, it's interesting because obviously we're all about staycations. I was in Cornwall just a couple of weeks ago. It was absolutely rammed. And it's probably the first time I've been to Cornwall in about 10 years. Beautiful, amazing, loved it. I think it's very popular at the moment. But as soon as them flights get reopened, everyone's going to jet off to Spain, Portugal, Cyprus, Dubai again, because they want the sun. And that's the only unfortunate thing. I was there when the sun was on. It was beautiful. It was amazing. The one day when it rained, you went straight into a bar and sat there all day because there's not much to do. And I just think there's a big hit on it. But I just think the holiday market in the UK is, and this is my own opinion, my personal opinion rather than a professional one, it's just hit and miss. I think unless you're buying beachfront and you're buying prime real estate, in an area where, the traders of London are coming and they're prepared to spend the big money, that's where you'll do okay. I can't justify a lot of people I know coming from Birmingham down to Cornwall. I'm just using Cornwall because I was there, and paying the money that they can see. You get a family of four and they're paying £3,000, pounds to rent somewhere, which is a holiday overseas for them. And I think at the moment it's very popular and there's a few tax breaks I'm aware of, but I just think once we're out of this and the flights are back to normal, you'll see a shift straight away. And that's my own opinion. We've seen prices increase, but I think as soon as you can fly overseas, we'll see the change and people will go to where they can fly. I sold in the Costa del Sol for a long time. We had the Costa Blanca, Costa La Maria came in. It was the new place, but you can fly to Malaga all year round. So it never lost really its big demand on it because you could get a flight there. And I think that's the key factor. So yeah, I think UK is okay, but I think it's nice to go for a weekend. But overseas will really come back strong.
And you're mentioning the tax breaks, James, because some of those are quite interesting. Could you let us know about some of the tax?
I don't know them inside, I just know of them. A good friend of mine owns a few properties down in Devon, and he keeps going on about the tax breaks for them. I have to admit, it's just something I've never really been interested in for it.
There used to be a tax break that you could run it as a business. So if you didn't use it, I could buy it in my name, and because it's an ongoing business, I can pass it to my children as an ongoing business. But I can't stay there unless I pay the market rent.
Okay.
And you're stuck with it. So I heard they were tightening up on that. It's really not a big area, as I said, big area for us. But I echo what James says. If I look at London, Airbnb, one of the biggest killers on the London market has been the lack of travel. I know I must have said it 25 times, but it is a reality, is no business people coming in. I had a flat of my own, which was in Kensington, and we as a business have about 25 properties that we short let, and that's on anything from one night up to however long anybody wants. And on the flat that we have in Kensington, it's my own flat, I was getting on average £3,500 a month. That was net income to me after all the costs. I relet it long term last March and got £1,750. I got half the rent. Now, that's okay. I've got a long-term tenant. I'm not paying the bills. I mean, the tenant obviously is a lot pickier and asking me to replace this, change that, because it's been short let for the last 7 years. So she's picking up on stuff that quite rightly needed doing. You know, but it's a incredibly highly manual market doing holiday lets. It's very, 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 you have to be involved yourself. If you're going to farm it out to a property manager, you're going to pay on a general holiday let 25 to 30% of the income. That's what it ends up costing you. If you want to do it yourself, they're going to call you if the heating doesn't work. They're going to call you. I mean, I got a call once that they'd locked themselves out. I had to drive there on a Sunday night to open the door, even though I'm an agent as well. But, you know, I think from a investment perspective, I wouldn't, you know, London for sure not. It works quite well for Airbnb if if your home is there, or you have a flat and you're going away and you're filling gaps. That can work quite well. But I do think there's going to be a drive. The moment flights are open, you know, look at what happened with Portugal. You know, people here, they like to go away. We love moaning about the UK, and this is the only year that the UK is at the top of the charts, because we can't well go anywhere else. But I think reality, I totally agree with James. I think next year you're going to see a reversal, and I think that there'll be lots of people that would have done Cornwall, really liked it, but then they'll be back on a plane, and I see that. I definitely, and London too.
Interesting. So
just to jump in, Jasmine, on the tax, on the holiday let side, it's looked upon as a business. So you get the tax breaks in terms of deducting the rent from your mortgage, which obviously a lot of buy-to-let investors can't do on standard ASTs. So there are tax breaks available there. But yeah, just echo what the guys have just said in terms of demand. I think as soon as the world opens up again, holidays abroad will become much more in demand, and I still think people will holiday in the UK, but certainly not to the degree that they are doing at the moment.
Yeah,
and I was going to say, Jasmine, just to add, you know, if you're buying the prime real estate in the holiday areas, you probably will do okay. Yeah. But then you have to ask the motive of why you're buying. Because if you're going to say, you know, I don't obviously know if that's the case of Annie, but if you went, I want to take the family there for 4 weeks in the summer, well, that's your prime rental season literally disappeared as well. So you've got to look at your income of when you want to use it, or are you just going to use it as a rental? Mark's quite rightly said about getting the managing agent. Unless you're literally there, you do need somebody there to pick up, you know, every little thing. But you've got to decide, if you're buying it for yourself and you think, well, yeah, it's great, I've got it for the family and the kids and a few family members, but you're buying for emotional reasons, not for business reasons. And never get confused. That holiday market can ruin people if you're buying under emotions rather than business.
Annie, where were you looking at? What were you interested in?
I was looking at the southwest, so Devon, really, but actually, yeah, possibly more emotional reasons. So it was good to hear the last comment, with maybe a view to moving. I don't know. So yeah, probably I'm in the emotional rather than the business. But going on from there, because I wanted the people to ask questions. You mentioned in the beginning about the New Zealand and the Canadian market going high. What about getting into that market?
What do you think, guys? Who would talk? Who was it? Who would say it was James? Colin, I'll come to you in a moment. Brilliant. James, was it you or?
No, Daniel talked about 33% in Canada.
Oh yes. So what do you think, Daniel?
It was something that I read on a property website a while ago, and I've got no experience at all of the markets over there and whether they're, you know, good to buy or not. So probably not the right person to ask on that.
I'll give you a small thing. So I travel to Asia a lot, and I travel globally a lot because we have clients globally. So I'm very long in property, and I do have other assets. I invest in the markets. I invest all over, but my main investment is in property because I work in it. So I hope I know a little bit about it, not very much, but I know a little bit. But because I was in Malaysia few years ago, I thought everybody was saying buy Malaysia, buy Malaysia, buy Malaysia. So the idiot that I am, I went ahead and bought a 3-bedroom flat, and I would never dream of buying a 3-bedroom property in London. A, I couldn't afford it, and B, you have to rent to 3 sharers, God help us, or a family, and that's much more difficult market. I bought a 3-bedroom flat. The hassle that you go through for me was exponentially insane. I had to go to the Malaysian embassy, to stand in a queue for an hour, to have my passport stamped, to go away to send that, and then have forms done. So not only was the legal part a nightmare, The process itself, the loan was easy. The loan was simple. They arranged me a loan and that was nice and easy. But the management system in different countries, and Malaysia is a good example, is the agent takes their fee up front and you never hear from them again. They don't reference the tenants. I was just lucky that my tenant paid. And when I sold it, I did make a bit of money, but I made more money on the currency than I did on the flat. And then I thought, great, I must be a fantastic currency trader. But the reality is, I don't know anything about currencies. And it could have gone totally the opposite way. And I could have lost 30% on the currency. As it happened, I made 30% on the currency, but it could have gone the other way. I then, because I thought I knew what I was doing with overseas investment before I sold Malaysia, I bought a unit in Sao Paulo in Brazil. And I thought, wow, that's exciting. I'm going to be able to go and see it one day. So again, I bought a two-bedroom, all in dollars. I bought it through a very well-respected financial advisor in Hong Kong who was selling this project. I agreed the price, which was, I can't remember what the price was. But what I didn't realize until they started asking me to top money up is that in Brazil, the price that you sign on the contract is not the final price you pay. The final price you pay is what the housing market has got, the construction index has gone up by. So if the cost of cement goes up by 5% and bricks go up by 5%, that means the cost has gone up by 5%. So your cost price goes up by 5%. My property between offering to completion went up 32%. So I'd agree, I ended up with this extra amount of money to sell. Again, it was a nightmare going through a legal process. And then the last thing was, HSBC just decided they no longer wanted to lend on Brazilian properties. So the loan that I had in offer was withdrawn and I had to mess around getting it there. In the end, I did sell it. And again, I made a little bit of money on the currency because obviously sterling was doing quite well, but it could have been the opposite. And the reason I say that is because this is personal experience of someone who works in property. And actually, it's so easy to get sold things. And I'm the easiest person. People sell me nonsense every day of the week, usually my children. But generally, I'm easy to sell to because I trust what people say. The thing I love about London is it's totally transparent, London or the UK. It's transparent. You know what you're getting into. You know what you're getting. And you know, what tenancy, you know, the law, it's all very around protecting you. And I feel other places are not like that. And Spain is different, I'm sure. But if you go to more exotic places, you have to be careful.
Oh, that really, really useful. Hope that helps, Annie. Colin, you've been patiently waiting. What's your question?
Yeah, slightly. Hello, Jasmine, guys. Sort of a mix actually of 2 points. And I'll take up on Mark's point about Brazil as well, because I'll lead on to that. We've got a property in Brazil, which we've been trying to sell. And we're wondering whether the best option is obviously to sell it and bring back the money, and I don't want to get emotionally tied, but it would be nice to actually have a property in Brazil, which is what I'd like. But the other question, bringing the money back, is my son's got an ISA. He's 11 now. He's got an ISA. He's got up to £40,000 in there at the moment already.
Great.
And what I was sort of coming to was, obviously, the money that we'll bring back from Brazil probably would be reduced because of obviously taxes and stuff. But as an investment for a property, and start to look for something now, because he's only 11, and something that we'd like, obviously, for him in the future. And obviously, to invest in something now. And then obviously when he's at university, that could be, again, something for him to move into in 10 years' time.
Brilliant.
Or
James,
8 years' time.
Could you answer the second question, and then I'll come to you, Mark, for the Brazil question.
Yeah, I think, well, very similar. I had it years ago. My kids, one will be going off to uni in a couple of years, and it's that dreaded question when they're sort of 9, 10, 11, you start wondering how you're going to pay for it, from there. So, yeah, for me, I think if you get into the UK, the property, you will lose a little bit of money coming back. It's natural, and I'm sure that's expected, but you sort of know it's safe again. And I think if you've got somewhere to give, look, for kids to go on the property market going forward, it's going to be difficult. I think we all know this going forward. The bank of mum and dad is going to get stronger and stronger. If the 5% mortgages stay around, fantastic. But at 11, you're not going to be getting a mortgage, at this point. I would be outside London because obviously it's where I operate. But I would be looking at your major cities that you can see the big investments coming into, in the infrastructure. That's what's going to drive it forward. And look at the commuter belts just outside, and if you pick up something, you think, right, I'm just going to get young professionals in there. You typically don't have many hassles with them. They pay their rent day in, month in, month out. Especially we rent a lot to law firms. With the deals that we have, because typically lawyers can't get CCJs against them because then their career is finished, and that's where we'll target, and that's why we do very well. We in all our history in Birmingham, I think we've only had 2 people not pay their rent that we've had to take to court. We've been very selective over the tenants we put in, but I'm a big believer, bring the money back, get it back where we're safe. Look at just outside the commuter belts, typically 25 minutes, I live 25 minutes outside of Birmingham. You'd feel like we live in the countryside. It's different. And I think then you'll do very well. You'll pick up the nice rents, get a good agent. We can help you out. And, we'll have it managed and looking well for you. And I think then it just allows it, because obviously when it comes to going to uni and paying it, you don't have to worry about currency again, going through, because universities no doubt will try and push their fees up in years to come.
Yeah, that's a really good point about getting lawyers, because they can't have a CCJ, a county court judgment against them. They really have to keep their noses clean.
Correct.
Probably having an MP would help as well, at least short term.
I'm meeting one later, funny enough, so I'll ask her the question, with Jess Phillips. Yeah.
Excellent. Mark, what do you think about the Brazil question? Should he go or should he stay?
That's it. I just want to take the law question, actually, because that's really funny, James, because so obviously we're in London and we get an awful lot of lawyers. Actually, we used to take the view, actually, we don't want to let to lawyers because
they'll fight you.
Not because they don't pay, because actually, honest to God, our debt rate is so low on people that don't pay. I mean, we run on 0.01% of debtors because we're quite careful on credit control. Like James said, we do reference tenants. But the reason we didn't want lawyers is because, number one, they put your contract to pieces and they want it totally written in their favor. And I'm acting for the landlord who's paying me, and I don't want the tenant having all sorts of strange clauses, one of which is I don't want anybody coming into my property until the end of my tenancy, which means I can't relet it without a void. And secondly, they drive you nuts if there's anything possibly wrong, and they start threatening all sorts of horrible things. But I'm not saying we don't let to lawyers. We let to a lot, but I'm just saying it's so funny because it
must be a London thing, Mark. We don't have that issue.
Good. So what about the Brazil thing element, Mark?
Sorry, on the Brazil element, yeah. I mean, my view on Brazil is I did it for investment. So I've been to Rio. I've got friends who live in Teresópolis. I bought in Sao Paulo.
What about Colin?
I think for you, Colin, I would, honest to God, I would sell it and bring the money back. You don't know where the currency's going. I think the pound is only going to strengthen now. We've seen a bit already. I think it's only going to strengthen. And it's as James said, having your money back in the UK. Yes, there are going to be some costs, and you can use a money broker to bring. In fact, you have to bring it back into your same bank account. But investing for your child for the long term, I think it's the great thing to do.
And one thing about investing for your child for the long term, I mean, you've mentioned this, Colin and James. It's about students. But if you're they're going to be a student. Student lets is an interesting area. Daniel, with your buy to let, do you have any people who specialize in student lets? Because I used to think, if I did this, I would do student lets. I quite like the idea. But now, when you see what's happening with universities, I honestly don't think that a lot of universities are going to survive the next few years. I think we're going to see some closing. What do you think about student lets in particular?
Well, I think there's always been, a high drive towards the sort of studenty areas. Typically they've been, your major city centres and areas on the outskirts. So I think for any savvy buy-to-let investor, it's not just about targeting a specific market such as student lets. it's always good to look at locations where you've got a wide variety of tenants, so young professionals as well as the student market, so that if one market fails, you've got the other to rely on. So yeah, quite possibly you might see some universities fall by the wayside. Hopefully not, because they're a British institute, aren't they? And no one wants to see anything of that nature to drop off. But I think any savvy investor, if they're targeting those kind of locations, you're looking at major city centres, so your Manchester, Birmingham, Liverpool, Leeds, obviously all the universities in London and the South. But you will get a mixture of different types of tenants as well as students. So that would be my answer.
Can I just add on that, students? Because actually we have a lot of clients who look at alternative classes for investment to get these 10% yields. And actually student accommodation was one of the biggest areas that drove a lot, because you could get 10-12% return on it. Of course, when they sell it to you, they don't tell you the downside. Yeah, you get 10-12% guaranteed yield if that's what they're giving to you for 5 years. What they don't tell you is if you don't have a student by the time that the university starts, you'll have no tenant for a year, because no one is going to, because often these student accommodation, if you're buying a property, is a room or a flat within a student house. No professional in his right mind is going to want to rent a room where everybody else is a student.
And not a 150 square foot room, at £80,000.
And there's no capital growth, there's yield, but no capital growth. There are often, it's a very specialist market to exit. If people want student accommodation and they purely, like Jasmine, you said about student, I would buy a fund. There are lots of student accommodation providers out there. I would echo what Daniel said. Do not just look for students, because you will end up on that road. You think, oh, I can give them any old rubbishy accommodation. They can have granny's sofa and I never have to decorate. They never shower. They don't even cook. They don't care. They'll just sleep on the floor. Students, A, do not expect that now. They expect high quality. And secondly, you want to be looking at professionals. Students are only going to be there a year and they may let to their friends. But I think, buttonholing your investment is very, very, very.
Can I come in there, Mark? Because I'm going to disagree with you on this one. So that's actually not always the case. So I'm building student apartments. I've got to defend myself here. So I've got 118 being built up in Newcastle upon Tyne. But you've got to look at the universities. So Newcastle and Northumbria, you've got two major universities. The average degree there is 3 to 5 years. So what you'll always find, your first year students, yes, they don't wash, they eat pizzas, they leave it for weeks, but they are crammed into your, 600 rooms right on top of the university for their first year. That's where everyone gets their life experience if they go to university, but once they've done their first year, they typically never want to share again, after that, because they're sick of people pinching the food, the noises, the parties. And then you do get, your purpose-built student accommodation. Now, years ago, landlords hated them, because when these arrived on the scene, they took a lot of students away from your houses of multiple occupation, to get in there. And students were changing. They weren't all going out partying all the time and getting drunk. They were starting to keep fit, health juices, etc., etc. And they wanted better facilities and amenities. And if you're a parent spending on average £25,000 to £30,000 on a degree, if you're going into engineering, medical, etc., you want to make sure that your child's safe, and especially from the overseas students. And this is where purpose-built student accommodation rocketed, dramatically. But there's a lot of rubbish out there at the same point. You see it on the market, a purpose-built student accommodation, 40, 50 grand, but it'll be nearly half an hour, 40 minutes away from a university. It's built cheap. It's never going to sell. And that's why I'll echo the comments there. It's different. That's
what I'm talking about, to be fair. I'm not talking about city centre built.
Yeah. Our student accommodation, for example, minimum to get in is about £85,000. Is the ultra end of the student market. People will buy it because we get, funny enough, the one we're building at the moment, a lot of our investors are children with their parents with their children in Bristol universities. Because of the amount it costs to rent in Bristol, they want somewhere to offset it. And that's where we've seen the big difference. And they want the facility amenities, their own space, the luxuries. And that's what then fuels cities to keep a hold of the students, because they don't want them learning there and disappearing off. They want to keep a hold of them. They then go into the apartments in the city centres, and that's what keeps that big circle turning and turning. But I agree, you have to be careful with what's out there. It's got to be run correctly. It's got to be managed right. And if it is done, you can do well, but you're typically looking at 7, 8, to 8.5% yields rather than your 10 plus.
Yeah, but it sounds to me that if you get it right, like you say, if you get it in a place where you've got at least 2 universities and maybe some other colleges, and ideally I would have thought a place like Sheffield, where you have a very high percentage of students staying on in the city itself, like you mentioned, James, then potentially if you get in that sweet spot, you could actually get really pretty decent yields and fairly risk-free, relatively risk-free.
Student accommodation can work very well if you're not concentrating on the one-year students. That's where it'll go wrong. You're competing with the big pension funds, that have got your big 600-800 rooms, and they will work on very small margins, high volume. You're never going to win the argument against them.
Yeah.
James, can I ask you a quick question? So on your stuff that you're doing up in Newcastle, what sort of size would a typical room be?
25, 30 square meters. But
right.
then downstairs we have 4,500 square feet of pure utilities, amenities, gyms, cinema rooms, on-site restaurants, Amazon style shop where they can use their lanyards to go and get the food and it charges back to them. So high-speed internet.
An investor would need to buy that cash then, so it wouldn't be mortgageable. And obviously resaleability for that investor, they'd have to sell it on to another investor in the future?
Not always. Everything comes with their own title deeds. So they can actually lend against it. It does need specialist lenders, but because they've got their own personal title with that, which is quite unusual, that allows them to do that. The only difference is the rules are it must be a student within the radius of Newcastle. I think it's 20 miles or something. So you can count Durham in that as well. But it all goes to people in Newcastle at Northumbria universities.
I have another question. And does anybody else have a question before I come in? Jackie, you're saying no. Anybody, because this is your opportunity to ask the experts. Annie, yes, hello.
Me, yeah. What about finding land and self-build?
What about that, guys? James, you're a builder. What do you think for a person to? It's a big project, but it's something that a few of us dream about. I'd like to get some land overlooking the sea and build my dream home, but I do know it's a lot of effort. What do you think for the average individual, James?
Well, I look at it to find land to build and make as much money as possible. So I do everything that everyone wants to hate on that. It's a dirty word, making money in property, but that's what property developers do. Our job is to get the land as cheap as possible, build it to the right quality, but as the right cost to get the percentage points to be able to keep funding it to go forward. I think if you're going to do a self-build for yourself, it's emotion driven. So it's all about finding where you want the land and where you want to be. But you've got to be very careful with development because the numbers can be very tight, and you've got to look at, who you've got to feed, what your finance costs are, what you're trying to build. If I take the West Midlands, we've got 3 developments on the go at the moment. So that's 18 houses plus 4 apartments and 1 commercial, all under construction. We will typically take about 15% profit out of each one. Now, it used to be about 22 to 24. So we've had to reduce our margins and be very clever with, the engineering to find out where we can save money, but not drop the quality on this as well. And you've got to be careful. There's a lot of a cost in building property. It's okay if you're going to buy a house, do a renovation, garage, stick the extension on, try making money that way. But if you're going to go into development and building, 5 or 6 houses, you've got to be prepared for your upfront costs. A lot of people don't realize how many costs there are involved.
It's difficult to borrow money on development as well. I mean, I actually put money into something called Blend Network, which is one of those peer-to-peer organizations, and they lend to individual developers because a lot of the banks aren't interested in that. Do you find that as well?
Yeah, they want to know everything about you. They want personal guarantees, even though you might be asking for millions, and there's no point. I haven't got the assets to pay that back, but that's just the way it works. It's all about the team, to be honest, around it. And I'm looking at, if you're going to build, one, it might be okay, but if you're going into, I deal in multiples. So when it's in multiples, we've got the architects, the QSs, the project managers, the whole team that then get involved in it. Before we even touch anything, we'd be 100 grand in fees before we've even bought the land. That's just to make sure that it's a good site to go for. So it does take a lot of negotiations, to push forward, but it is where the money is in development. It is, a lot of people don't like it. You know, and you only have to look at the press and you speak to people, don't buy new build, tons of profit in it, etc. But that's where you do make money a lot in property, is property development. There's no quick way around it. It does take, our Newcastle scheme that we're building probably took 3.5 years to get off the ground, nearly £500,000 in architects' fees, you know, surveys, soil nailing, you know, you name it, before we even start the steel structure. The actual build going up is the quickest part of development. Anything that you can't see under the ground is where all your money's going, and that's your biggest expense typically.
Now, finally, I have a question from Rosemary. Thank you, Rosemary. Lovely.
I actually have two flats.
Yes.
Which I bought about 6 years ago. And I got funding for them then, but I'm now in my late 60s. If I wanted to buy more, where could I find funding? Because obviously there's a tendency for them to say they won't do buy-to-let mortgages beyond 75, which in actual fact means that whatever sort of mortgage I get, I would end up paying more than I could actually let a flat for. Daniel, so the flats have been quite successful in themselves.
Great. Daniel, what do you think? What's your answer to Rosemary?
Well, you might be surprised. There are lenders out there that lend up until the age of 99, believe it or not. And they're generally on an interest-only basis. So even if it was 75, the actual cost of the mortgage, you know, if she's 65 now, for example, even if it's only 10 years, it's interest only. So the numbers don't really change too much. You just need to sell it by the end of the term. But TMW, unless they've changed the criteria, lend up well into past 75. So there are lenders out there that will do it.
That's really good. And so yeah, do ask. I would think you'll need a specialist broker, somebody who knows that area and knows about these ones. Daniel, are they generally a bit more expensive than the others, or are they?
No, they don't tend to discriminate on age. You know, it's about the property and the rental income. So it's obviously very different to if you're buying your home to live in which case it's done on income multiples. So yeah, just a case of speaking to a good broker that's got good knowledge of the buy-to-let market and some good contacts within the industry.
I've just got another final question from Linda. She says, let to buy process, ? James, Mark, have you got any thoughts on that?
I don't know how popular it is in London. In the north, it's not really probably took off yet. I think it may be something good for first-time buyers to help renters get on the market. And I think that could be the big success story going forward, to be honest. I think if you've got a big lender like your Barclays, your Halifaxes of the world, to really put their name on a development to say, look, whatever you're paying to rent, we will use that towards your deposits. That could be the next boom in the property market. Will we see it? I don't know. You know, it's the market's still very backwards on this. You know, so I think it might come eventually, but I don't know. I think it could be another 10 years before we see it take off.
I agree. I think it's a really good market, and I think it's a really good model with people trying, you know, with the 5% mortgages, with the 95% mortgage, 5% deposit. I think actually, if I don't think it's necessarily the banks. I think it's actually down to a developer, and the problem is the way developers are funded. They need to get out. They don't want to be sitting on stock. The reality is, if they could sell that into a fund who would then hold it, and then they would, you know, let you rent it for however long and then give you a concession about buying it. I actually think let to buy is a model we should be pushing here, but it all comes down to, James says the banks, but actually I think it's more to do with the developers. You know, they don't want to sit on stock. It looks like they haven't sold it and there's something wrong with it. They want to move on, sell it and move on. And
that's why I say it's the banks, Mark, because we want our money and gone.
And finally, I've got a question from Harvey. He says for James, what are the top 3 areas to purchase an investment property around Birmingham, the Black Country, e.g. Walsall? What are the top 3 areas in your
top
area?
3 in no particular order? Dudley, Walsall, and then I would move out towards Lichfield.
Nice one. Well, that's a fantastic. Thank you very much for coming. Thank you, Daniel, Mark, and James. You've been lovely, and thank you, James Lockett, for popping in as well. And you know, James is their minder. So great to see you.